Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, and I'm joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, co-founder of LikeFolio. Welcome back to the show, Landon.
Thanks, Tom. Good to be here.
All right, so we're talking Stitch Fix. They report after the close. I was looking at this stock. It's a $5 stock. It's just been pummeled about 75% so far in 2022. And it seems to me, Landon, I'm pretty surprised that we're seeing just such a pullback, because I hear all this stuff about people going back to the office, people going out to dinner, having travel plans. It seems like everybody should be getting new clothes and ditching the sweatpants that they've been wearing for the last 2.5 years. But this stock price doesn't reflect that at all.
Yeah, you know what? They're getting new clothes, just not through Stitch Fix. Okay. I mean, that's the problem. There's a lot of places you can get new clothes, and their business model just isn't working right now. I mean, yet you look at the stock at the end of end of 2020, it was $113. Now we're under $5. Absolutely incredible, just decimation of the stock. And when you look at the data, when we look at what the LikeFolio data looks like, it actually makes sense. I mean, the stock peaked around, I think, COVID times. Everybody started to try it out. Pretty interesting new thing. But, it's really fallen off since. But you talk about, shopping for new clothes. That's actually down 8% year over year. So a lot of, there was a little bit of a boom in the spring and summer, but now, things are kind of falling off a little bit year over year. So they actually don't have that behind them. But even if they did, it wouldn't be with Stitch Fix. A lot of people are going other places. Even when you look at more specific trends towards them, like clothing resale or clothing rental, those are either flat or down around 10 points as well. So not a lot of trends helping this company out. They've also got competition. There's Rent the Runway, there's Nuuly by Urban Outfitters. And both of those are doing much better than Stitch Fix on not just in purchase intent, which is a pretty ugly story for Stitch Fix, down about 39% year over year, but also on happiness. Stitch Fix is the worst of all three. Nuuly is sort of the newcomer to the market. They're much smaller. They are a subsidiary of Urban Outfitters, so they're backed by a much larger company. And it's sort of just that company, Urban Outfitters, kind of taking a shot and saying, hey, if this takes off, great. If not, no big deal. Whereas Rent the Runway and Stitch Fix, this is what they do. So the fact that they're both being beaten by this larger company that's just trying something is a little bit concerning. Also, I want you to note the happiness here. I mean, normally when you look at a company with 79% happiness, that's Stitch Fix, that's a pretty good number. Rent the Runway is doing a little better at 83, but Nuuly is incredible at 96. Almost no complaints from consumers when it comes to this brand. So Stitch Fix is on the wrong side of this chart. You always want to be top right. Bottom left versus your competitors is not where you want to be. So it makes a lot of sense why the stock has been why the stock has been selling off so much. Even if you look at Rent the Runway's last report, they laid off about 1/4 of their employees. The stock's down 39% on that reaction. And with Stitch Fix coming up tomorrow, there's not a lot of good news. The only real, I guess, good news I could say is that we don't see things getting worse than you might expect. It's still going pretty poorly, but it just continues to decline at a steady pace. So it's not flattening out, it's just continuing to decline at a steady pace. It's not falling off a cliff, but that's not going to be the type of message that investors want to hear.
Landon, their CEO, Elizabeth Spaulding, she came out with a comment and said, we are moving with a sense of urgency. They're slashing costs, they're reorganizing their sales process, but they lost 200,000 members last quarter. From up small and up bigger the last 3 quarters, it's going in the wrong direction, Landon. And with new players out there, isn't this just someone's got to rebuy them and reorganize them, or they've got to go quickly, or this is the long goodbye in this name? Because you can cut all the costs you want, but if your customers are losing, it's just a matter of time, Landon.
Yeah, I mean, there is a clock, right? I mean, they only have so much cash. The valuation of the company is down to, I think, $500 million. So it is falling pretty quickly. But yeah, it's now or never, I think, for this company. And honestly, I don't know how attractive of a buyout target they are. You've got, if you're a competitive urban outfitter, you're looking at Newly saying, all right, they've done it. That's pretty interesting. And I guess at some price, Stitch Fix becomes attractive to a competitive urban outfitters, but I don't know that it's here just yet. So I am concerned with this company. They've got to turn it around quickly. Everything that we've got on purchase intent and happiness is pointing in the wrong direction. Again, the only good news is that the pace of that decline is steady, but it is still declining.
Yeah, and just looking at the consumer purchase intent mentions on this, you guys were ahead of the game. It did spike in 2021 when there was a ramp up in people buying new clothes after being on lockdown for about a year. But you guys have seen steady decrease there. Now, the stock price is below this chart right here as far as the consumer purchase intent mentions, Randy. Or Landon, is there anything there? Because, Nordstrom bought Trunk Club a couple years ago, right? That was in the same type of space. Is there any hope for this company based on that type of data where there might be a blip where, hey, you know what? People are traveling, people are spending still. Maybe we do see a quarter ramp up and kind of notch into that because they are continuing to lose money at this point.
Right. So just for a little clarity on this chart, the green line's purchase intent, people saying I'm signing up for Stitch Fix, basically, or I'm using Stitch Fix. The gray line or the sort of the white line is the stock price. They're on different axes, so whether or not they cross is not that relevant. It's really just you're looking at the direction. And that green line, just steady decline. It's really ugly, and the stock price is lower than we saw in pre-COVID days, but they had more cash then. So this is a company that is in decline. I think that what they need is they need to have a pretty serious turnaround. They need to do something fairly dramatic, get some new customers in the door, and really cut costs if they want to be a standalone company and make it. If they want to be acquired, then eventually the stock price is going to get so low that maybe they're worth acquiring, but they better be way more efficient than they are. Taking on a company that's just burning cash isn't the most appealing. You've got to have solid infrastructure, and you've got to have a good marketing offering for the customers. Otherwise, what's the point? Why not just make your own company, sort of like Urban Outfitters is doing with Newly? So I'm a little concerned here. They've got to do something. I don't know what the plan is. I think that investors are going to be listening very carefully to hear what that plan is. But as far as the earnings report goes, I can't imagine that the turnaround has happened in the quarter that they're about to report. It's got to be, in my opinion, it's got to happen in the future because it hasn't happened yet. Based on the data that we've got, I don't see any dramatic positive news coming out of this earnings report.
Yep. So I'm guessing a low score on this one going into the report, Landon.
Well, what's crazy about the earnings score, and as I've said, the decline is steady. So our system kind of looks at what's the change in the rate. And since it's pretty much steady, we're only about a -10 right now. So we wouldn't be betting the farm against them. We don't think they're going to shock to the downside. We think it's just going to be continued bleeding, which we believe the market will expect. At some point, the market gets tired of that, and the cash reserves run dry. So the stock should continue to decline. But what I'm saying is our data does not show any signs of positivity. If it did, even a flattening would show like a +50 on our score because it's just been so negative. But there's not even a flattening yet. It's just a continued decline. So I would stay away from this one and probably just bet against any kind of big bounce on this.
Yeah. Full disclosure, I used this for a couple months. It was actually decent, but I think your data kind of reflects that, Landon. Maybe if you do subscribe to this type of service, after a month or 2 or 3 months, maybe you just kind of leave the service. Maybe that's what your data is showing here because they continue to lose subscribers. All right, great stuff as always, Landon. Appreciate it.
Thanks, guys. Take care.
All right, that's Landon Swan, co-founder of LikeFolio, breaking down the negative Stitch Fix data here, Kev. Kev, this is